guys, Freaky Finance here. Today we're gonna look at Amazon and Enbridge. It's been a crazy week. I still got to go through Mobileye. I think Wendy's reported Volta, which is Dufree, Apple, and Badger are just a few names that I still have to go through. But today it's just gonna be Amazon and Enbridge, mainly because I own them both. So I'm gonna show those right here, and so you can see Amazon on the left and Enbridge on the right. So both of these I actually own. I'm going to do a video I think on covered calls because it's just so interesting relative to the underlying asset. Both of them, I won't go into too much detail, but they own the underlying asset, so they both go up with the asset. But they're also leveraged, so they borrow, and then they also write covered calls, so they write calls. And basically what they do, you get more income out of it, and you still participate in the upside. That's the idea anyway. Now, they're not as proven yet. I've been starting to use them to juice up the return, obviously decreasing the size of the weight to make up for the higher risk. But yeah, anyway, that's what they are. That's why the tickers look different. So YAMS instead of Amazon, say MZN, and ENS instead of Enbridge, EMB. And again, I own Amazon on the Canadian side. So in terms of this week, I want to say Amazon is probably the most surprising. Well, Mobileye was interesting reaction, but I mean, Mobileye was just getting destroyed. Anyway, Amazon, strong numbers year over year across the board. It's crazy to think AWS is now almost as big as the entire international Amazon. Wasn't too long ago that wasn't even close. So in terms of sales, doesn't tell you much. It is interesting to see how big Amazon's getting. This is trailing 12 months. Largely, I mean, I want to say if it's not this year, it's going to be next year where they're going to be neck and neck or maybe ahead of Walmart, depending on how Walmart does in sales. So it'll take over as the crown of the most sales in terms of top line number. I haven't looked at Walmart for a while, but I remember they're over 550 billion last time I looked. So I'm sure they're around 600 now or more. But anyway, net income shooting up. I mean, the net sales across the board shooting up. You can see the scale showing up on the cloud side. That's a 50% year-over-year increase in operating income on cloud while they're investing heavily in cloud. Now we're going to go through one of the reasons why on the call. Honestly, if you want to listen to a call this week, it was Amazon's call. It was better than normal Amazon calls, I want to say. It was very insightful to the mind, the share, and there's just the thinking behind management. I know this is probably really small, but it's just so big here. But I just want to point out on the cash flow. When you make 50 billion on a trailing 12 month, right here, and then you add back depreciation and share-based comp, you're at 123 billion year over year without the working capital noise, which is a crazy big number. But I will want to point out that they're putting 70 billion back into themselves, and they're expected to do 75 billion in 2025. So they're investing heavily in themselves, and that's a big number, right? 75 billion a year, or 70 billion on the trailing 12 months, backwards looking. That's huge, right? It's way more than $1 billion a week. So definitely impressive. And we're going to go through some of the things that they're investing in. They're honestly investing in a whole whack of things. And it's not like they have a breakdown for like this much capex is for this. But we know a lot of the increase is for cloud than it has been for a while. Actually, interesting enough, they did a big capex push for their distribution during the COVID when they had to do some catch up when all the shift and spend shifted to goods. Amazon was a big beneficiary of that during the shutdowns. And so they like made a whole whack of investments in distribution and actually cycled that through. And that's one of the reasons why cash flows improved so much, I think. And now it's interesting to see how they're going to do next year. I mean, the underlying economics of the business just to continue to show scale. And we're going to go through that right now after this. But I did want to point out, what are they doing with the cash? Honestly, it's sitting on the balance sheet. So what's interesting, they probably will do a buyback at some point. But right now, they have been slowly buying back debt, or paying down debt rather. So that's about it. But you can see overall they started with 50 billion and now they're at 78 billion. So they have let most of it sit on the balance sheet after putting well, most of it goes back into the business, then they're letting the rest of it sit on the balance sheet. That's what I'm trying to say. In terms of the scale, you can kind of see here what's going on. So when your revenue shoots up more than 10%, and you can see cost of sales kind of keeping pace, fulfillment's kind of keeping pace. So those things, I mean, you're seeing it in absolute numbers show positive, but in terms of percent, it's not that big of a scale. Where you see the scale is these three lines, which imagine you're just growing like 46 billion year over year, and you only have to spend 1.4 billion more in technology and infrastructure, right? You actually spend less in sales and marketing, and then you spend less in G&A. Now there's a little bit of noise here, but you can see relative to the increases that we're seeing in revenue, these things are barely increasing. In some cases, they're decreasing. So that's amazing. So that you're seeing scale across all the line items while revenue continues to accelerate, especially on the cloud side. So it's just, I don't know, it's just amazing. Now, what I want to, like, I like to see, I'm a sucker for buybacks, right? So I want to see them start doing buybacks with the cash flow or something. I mean, they're trying to do it to offset dilution, and that's pretty much all they've done. They haven't taken advantage of anything. To be fair, Amazon's never been exactly cheap, but it is cheap relative to other mega caps right now. And I think a reason of that is because of the shareholder reward. Here's just the balance sheet just to show it. It's not as pristine as, say, Apple's or Google's. You can see here they do have 75 billion plus another 12, so they got what, 88 billion dollars in CCE. But they do have 54 billion in debt now, 55, which has gone down every year. So they have been paying down debt slowly. So maybe that's why they wanted a bunch of cash, just to make it themselves way more than cash neutral. But I mean, at some point they're gonna either, given capex only estimated to be 75 billion next year, they've got to do something with the cash. And maybe they keep making acquisitions, but maybe I don't know. They have a lot of things they could do. This, before we get into the call, this is probably one of my favorite notes. It's just the AI, because it links back to what I think as a dispatcher, like a Uber or Airbnb, and just how it's gonna just only improve with AI. And I think matching things online, so like a person's personal preference, you get to see what the end user is looking at, and you get to put things in there for them to increase conversion. And I think Amazon's positioned so well for this, both in terms of the storefront itself, but also just matching at the back between like the suppliers to the user, to the customer, right? It's just like, I just think they're gonna easily just dispatch what you want to see, and it's just gonna increase spending and conversion rates, and it's also going to improve the advertising market that continues to grow very well at Amazon. I mean, we can go into a whole bunch of other things that they're doing, but it's too much for this little recap video, right? We can go into their movie segment. We can go more into AWS. I might do a deep dive on Amazon just because there's so much going on, right? Like pharmacy and all this stuff. But that's the main point from this call that I was listening to. Or this quarter rather. And here's just the long-term trajectory. You see it going from 100 billion in 2015 to 575 billion at the end of 2023, and it's going to surpass that by quite a bit this year. And then it's going to likely continue to trend. And one of the things that you see here is how much COVID benefited it. So they've been fairly profitable. Then it was $1 in earnings power. Then also it was $2 in earnings power during COVID. So basically doubled. And then it 50% more in 2021, and then we kind of had this shift from goods to services, and then this is also when they invested a lot more in their capex. So they went through a big distribution capex basically to increase fulfillment times, and we saw that they also pushed a couple videos and movies and stuff like that, which weren't in my mind economical, but and now we're kind of on the other end of that, I think, and we should see exactly what $75 billion a year in investing yourself does in the long run. But it's just amazing in terms of the economics that I think we can see here. These are just notes from the call that I thought were interesting. Again, it's one of the better calls this week. At a time when consumers are careful about how much they spend, we're continuing to lower prices and ship even more quickly, and they're resonating with our customers. As our unit growth continues to be strong and outpace even our revenue growth. So they're shipping more units than they are as percent terms relative to how fast they're growing in revenue, which is very interesting. And then they just say they're helping customers save more money, and we've seen that value trend. Like Walmart says the same thing. People are trading down to value. Um, Here's one of the things they're investing in, and I thought these numbers are pretty interesting. This is our first facility that incorporates the newest robotics inventions to simplify stowing, picking, packing, and shipping. So think of the whole distribution side, except for driving. Thus far, this new design reduces fulfillment processing time by 25%, increases the number of items we can offer for same-day delivery, and expect to drive a 25% improvement in our cost to serve during peak. Just so that's by itself is pretty amazing, right? I don't know. It's 25% faster and 25% lower cost. And then you also have things like advertising, which is up 18% year over year, which continues to only improve the existing Amazon platform. And I think, again, advertising is just an easy place. Digital advertising specifically is just an easy place for AI to improve on. Just matching eyeballs and intent. Increasing the return on ad spend for any company, really. This is interesting. It's kind of like I always like how they smash. So Amazon, for some history, we looked at Intel very long ago. Amazon was one of the first ones to come up with their own chip, the Graviton, or the Graviton, and anyway, it's always been superior to x86. x86 is Intel's stack. It's the older stack, whereas phones like TSMC, NVIDIA, it's all RISC. So totally different network than x86 processors. They just haven't been able to be as energy efficient as, say, the cell phones have started to become, which turned into chips. So one of the reasons I think Intel got leapfrogged is because they were sleeping on how quickly phones were evolving in their architecture. And things like chiplets at AMD and stuff like that were just showing up better in terms of energy consumption. Anyway, that's neither here nor here. I just thought it was interesting. And I do think, to what it's worth, I do think these companies are going to try to figure out how to make a chip that's better than what NVIDIA is putting out right now. None of them can right now. That's obvious because they're all buying with NVIDIA. But I think at the end of the day, they're all going to want to figure out a way because they're aware of how much money NVIDIA is making off them. And it'll be interesting to see if any of these big guys can do it, whether any of the cloud guys, right? Whether that's Apple, Amazon, Google, or Meta, even Microsoft, right? If any of those guys, with all the money they're investing in themselves, come up with a better chip. But anyway, it's neither here nor there for today. And that's just speculation anyway. This is just the capex number where I'm pulling 75 billion from. So again, huge number. Here is just one of the reasons why margins improving. Like one of the reasons why, which one is it? This one, the increase in operating income. Right. Well, 2% of that is from the average life of the where it is right here, the extended useful life of the service, and we talked about that yesterday, I think, or the day before. They've also seen more improvement on hiring and staffing. Their office staff is actually down on a year. That's office staff down on a year when your net income's up 150% and your revenue is up 12%. So just imagine selling 12% more things with less people, right? Technically more than that because revenue growth was slower than its quantity growth in terms of units sold. Anyway, I find all these stats interesting. And then this is another interesting stat because people are like, Amazon's so big, how can it keep growing like it is? And they claim they're only 1% of the market segment share for worldwide global retail market. And 80 to 85% of the market segment still lives in physical stores. And so if you think that equation is going to flip in 10 to 20 years, there's a lot of opportunity. So I do think Amazon still has a lot of room to run, especially in the world. I mean, maybe you can make a little bit of an argument in North America, but they're still just taking share everywhere. And it's just the service is just getting better, right? It's getting quicker, it's getting more efficient, it's getting cheaper. Like it's cheaper for me to order here staying on my computer than it is for me to go out to a store, right? It's just, so not only is it convenient, but it also saves me money and time. Anyway, and then this is something I always like to look for because Amazon's so big that it's also like kind of like how I look at Visa for a macro proxy. I also look at Amazon for a macro proxy, and they're still saying like they're taking more share in essential everyday items. So that's like their think like a great value line or the cheap stuff that Amazon will make either directly or still outsourced to a third party. But a lot of these are first party, so Amazon actually makes the things themselves and sells it themselves. And the thing is, this is something I really love aside from the AI side is whoever has the end sale or that relationship with the end customer gets to see exactly what the customer wants, and not only are they able to match on the AI side, but they're also able to match them to like lower selling pricings if they know that customer is looking for value. Um, and on the store side, they also see what's selling and what's not. And so if they're like, well, I think I could do this cheaper than what's currently out there, and we know what the volumes are, and we probably know what the margins are. Let's just cut them out and make it ourselves and make it cheaper for the end user. And I think that trend's only going to continue. And Everyday Essentials is just going to slowly beat out on a lot of little mom and pop stores over time, or just even just normal retailers that try to sell on Amazon. If the product is so good and Amazon thinks it could do it better, it's going to. So I think that trend's only going to continue. So that's about it for Amazon. It's probably one of the better quarters in terms of like visualizing what the future may look like and the opportunity set that's still out there. Enbridge, totally different beast than actually every company I think we talked about this week. It's not a growth, it's like a stable, kind of boring company. Very steady cash flow, a lot of debt. So a lot of these it's like utility proxy is what I call it, pipeline. In Enbridge's case, it's already half a utility now after its recent acquisition of Ohio, North Carolina, and I think what's the other state, but I think it's Utah. But anyway, you can see in terms of the cash flow, a lot of it goes back into the business. But a lot of it goes like this. You can see acquisitions. I mean, it's a little bit of outlier because I just made a huge acquisition. And again, in my mind, one of the best acquisitions I've seen for utility in a while. They basically like bottom ticked a distressed utility and needed to sell off some assets because its debt was too high, and Enbridge basically just took advantage of it. And I got him on a relatively cheap price, I think. So again, just strong asset allocation from Enbridge. In terms of the balance sheet and you can kind of see how it happens. So a lot of the cash flow goes back in the business, and technically, if I didn't even see this 13 billion in acquisitions, you wouldn't be able to cover the dividend, right? So you have 6 billion in dividends, you made 9 billion on 9 months in, so you have 3 billion to play with, and you spent 4 billion. So no matter what, you're going to take on debt, and then you took on even more debt to fund the acquisitions, and they also issued shares. So that's where the cash is going. It's kind of I find these utilities are like always growing, always bulking up in size, because the bigger the size, the regulators see them as lower risk, and they can get a lower cost of capital, lower R, and that further allows them to keep growing. And that tends to work until it doesn't, right? We've seen things where utilities take on more than they can chew, like AQN, or the utility, I can't remember the name, it was an American utility that Enbridge took advantage of in my mind. Here's just the balance sheet, and again, it just shows the relative, just the debt, right? So you have debt at now 87 billion versus 74 the year before, right? Current debt's even up 1-2. So I mean, in terms of assets on the side, you have 18 billion in long term, 2 billion in cash. So it's not like these balance sheets are good. None of the utilities and pipelines are good. That's one of the reasons why they have a moat. Is because you need to basically take on debt to actually do any of it, and you rely on cost of capital so much. And this is probably the best slide to show that. Is just so you do see good EBITDA growth year over year, and this generally happens whether it's with inflation or with riders. Let the utilities allow them to earn each year. You'll slowly see, like in this house, you'll slowly see utility prices go up, right? The bill goes up each year. And the same thing with pipelines and tolling agreements. You'll see it slowly go up because basically the cost of service slowly goes up. And same thing with utilities, and which Enbridge now has more of. And you can see in terms of the segments, liquid's the biggest, but now transmission and specifically distribution lately has gone up. One of the things I want to point out is while you've seen this go up by 330 million year over year, which is good, you do see a lot of it is getting eaten by the bondholders, so the financing. You can see 230 million. So of the 330, 230s going here, right? So, and you have more maintenance capital and stuff like that. But anyway, a lot of it is getting chewed up by this, and that's what's interesting with a bond proxy. What I call Enbridge is that during an interest rate increase cycle, Enbridge is under pressure because financing costs are going up. At the same time, EBITDA is trying to catch up, but it catches up on a leg. And what will be happening, interesting now, is when rates start coming back down, how Enbridge reacts, right? Because we should actually see financing costs finally stop getting worse in terms of rate of change. And so even if it just flatlines or goes up slower, well, EBITDA growth will keep chunking up because it still needs to catch up a bit. I think is interesting. So that's one of the things when that spread between the two gets worse and then gets slowly better, you should start seeing a recovery. And I think we're already starting to see that. I think that's why Enbridge has done so well of late, but so weak on, say, a 2-year stack. And you can see that here that it's still feeling the pressure. Like even so, the recent issuances are all 5 or 7%, right? Maybe you can say this 4.2, right? Due in 2030, but the bulk of them are in this higher whack, right? And then if you look at what they've repaid, you can say a lot of them are just in the 2s to 4s. So you can see the whack is still increasing. So I think that's obviously showing up here, but I think it's also still showing up for now. And at some point, it won't be as yet readily as obvious. It'll be like you're issuing debt at 4% and you're currently retiring debt at 4%. And you won't see this bigger increase. You'll see it slowly increase because it always will, because they're basically always growing or dying. You need to keep bulking up. You can't like stop because you need the EBITDA growth to get a decent cost of capital. So you're kind of stuck in this loop of always bulking, always getting bigger. So the trick is to make sure they're getting bigger at the right times, buying the right assets, and investing in themselves in the right ways, and getting that higher ROE that they can from the regulators. The liquids pipeline is doing fine. I mean, the main reason why it's higher is because they have annual escalators on the main line. The volumes have been pretty strong for a year. So it's not like in terms of rate of change, the volumes they're still like really strong. So it's mainly just you're seeing a little bit of escalator. I mean, there's always, I like Enbridge because they take out like all the infrequent and non-operating. So one of the reasons why this increased so big this quarter is because of mark-to-market value and derivatives. So you take that out, they're like, oh, it only increased by 44 million. I like how they just report things. Gas transmission, same thing. Favorable contracting, lower operating costs, and then they make some acquisitions. So, and then the gas storage, full quarter contributions from Enbridge Gas Ohio and Enbridge Gas Utah. Again, the recent acquisitions. One of the cool things I like about Enbridge is what I saw them react to with we saw the hub, like we're still seeing price disconnects, right? Europe has almost like a permanently higher nat gas price, TTF, versus say Henry Hub, versus say ACO, versus say JKM. And so I like what Enbridge has done, and they've actually been adding to storage, and they've been acquiring utilities that have storage. Especially near export centers, and they keep expanding around these export centers, and I really like that because it will allow them to take advantage of price dislocations when prices blow out, and it will technically make the world more efficient in terms of hub hopping. It won't ever be perfect because it always costs so much to transport on a boat to a different continent to get that spread, but it's just interesting anyway, and I like the strategy because it makes a lot of sense to me, especially when so many different countries are trying to go greener at different rates. It's just going to blow out these spreads between different continents, and I just think this is really smart. So I like that. It's just, again, you get a decent way to play that while you still get the stability of the actual tolling agreements and regulatory agreements. We haven't talked too much about solar because it is so small. It's worth bringing this up because Q4, when a project goes into commission for an Enbridge, you basically get that the next like 12 months or 4 quarters, you get like a rate of change increase in EBITDA. So that's like why EBITDA keeps going up, is because these projects get complete and they go into service and make money, right? There's a big leg. You got to put all this cash to work and then you make money. And so it's like you put cash to work, then you see the EBITDA. So one has to come before the other, and you're always looking for rate of change increases in EBITDA. So there's going to be a couple here from solar. I did think it was interesting that we're talking about Amazon, and then you can see one of the things they're doing is for Amazon. We have seen a lot of specifically renewable energies for tech companies, and that trend's probably going to continue because they're trying to be more green with their output and technically more efficient after they're built, right? Because these things, like once you have it built, it's actually really cheap when you bid in. Once the capex is built, you can actually scale it pretty well over a very long term. Utilities are kind of interesting, right? So you have more rate pays. I think that was mentioned here. Yeah, higher distribution charges from rate increases in customer base. So that's always what happens with utilities. The rate base should always slowly increase, and the population growth should always increase. Now it doesn't always increase, but you can see basically how utilities make more. You need more people, and you charge them more. And you can see that here. It is interesting that Utah's population grows 5%, but estimated through 2028. But I mean, utilities are very simple to me. Like we made a decent amount on ATCO, but again, they have this like it's hard to you almost need to bridge yourself from the other ones where I'm always looking for like EPS, like share buybacks, and better balance sheet. I haven't found a utility where I'm like, yeah, the balance sheet's amazing because it doesn't exist. But anyway, these are just new projects that are coming on in 24 and 25. So Venice is, I think, is November, and then you have Fox, and I think it also is Q4. So these will help them for 2025, and basically always have this rolling cadence of projects expected to be done. And that's how you get that steady EBITDA growth each year. That's why you keep seeing the debt go up each year because it costs money to put them into service, and then they make money, and that's just the trend. And so what I like about Enbridge is that it's like if rates are slowly coming back down, we should actually see the financing cost stop increasing so much relative to EBITDA growth. EBITDA growth should still slowly continue, and the financing cost in terms of rate of change will slowly come back down. So one will decel, while one will stay the same. Whereas the last year, really, since inflation and interest rates shot up so much, we saw the opposite. We actually saw financing costs accelerate while EBITDA growth was kind of flattish. And so we see EBITDA growth continue, but EPS growth slow down, right? And you're actually seeing that right here still. So it's still showing up. So it was still getting technically squeezed in a way, if you look at it that way. But anyway, I'd like to know your thoughts on Amazon and Enbridge. We're already 27 minutes of me rambling on two companies without even going deep into any of them. That's just my general thoughts. I own both of them, and have a great weekend. I know I got a bunch of reading I got to catch up on, so take care, guys. And yeah, I think by Monday anyway, I'll have my office back downstairs set up. Take care. Bye now.